This Canadian compounder is on sale today, in my opinion. This is a company I own and is also a company I'm going to be continuing to buy once my account transfer from Wealthsimple Trade over to Questrade goes through. I think this company is trading at relatively large discounts, especially when we look to historical averages, primarily based on some what I believe are short-term headwinds. So everybody, I'm going to be going over this stock in depth in this video. It won't be one of the shorter videos. And as always, if you like the video, head down below, like the video, subscribe to the channel, drop a comment. Let me know if you've ever even heard of this company, because a lot of people don't know this company even exists. It has a huge runway for growth. It has executed very well over the, last 10, 15, 20 years. However, there's a bit of headwinds right now that are offering up some pretty attractive share prices. And as always, everybody, if you want more research on 3 of my favorite stocks for 2025, there's a link down in the description, and I'll drop a link up above here. You can grab that report absolutely free. But let's dive right into the video. So I'm going to be going over Boyd Group in this video. Now, this is kind of a mid-cap Canadian stock, and it is a Canadian stock, but the bulk of its revenue comes from the United States. So this is a Canadian traded ticker with the vast majority of its revenue south of the border. So I'm going to go over that a bit more later on, but what I do want to get through is what exactly Boyd does. So effectively, Boyd is an auto body and glass company. It operates under Boyd Autobody and Glass in Canada, but down in the United States, it operates under Gerber Collision. So even though this company is called Boyd, the bulk of its stores are going to be Gerber Collision. So historically, it has a 10-year revenue compound annual growth rate of 15%. It's got a 10-year adjusted EBITDA compound annual growth rate of 12.7. And the thing about adjusted EBITDA is, companies can modify this however you want. Pretty much Boyd just takes acquisition costs, things like that, adjusts them out. Their adjusted EBITDA is very, very close to their actual EBITDA. So this is a relatively accurate number. And you're looking at a 10-year total shareholder return. This would be a compound annual growth rate of 17.8%. This company has done very, very well. So it operates in the auto body and glass industry, which is a $50 billion industry. Now, Boyd is the second largest player in that industry, and it only has revenue of $3 billion. So think of that. It's the second largest company in its industry, yet it controls a little over 5% of the market. So what this company primarily does is it acquires mom and pop collision repair shops. And then what it will do is it will kind of rebrand them to the Boyd or the Gerber brand. It will put operational efficiencies in place to improve margins, and then it can utilize its large cash flows and the brand recognition to get more business. The bulk of this company's business comes from insurance companies. So these are auto claims that would be from insurance, and as a result, the revenue stream is relatively consistent. It's a bit economically sensitive, which I'll get to in a bit. But for now, what you need to know is the company is primarily a play on insurance companies, automobile repairs, collisions, things like that. And if we look at the chart here, we could see 92% of revenue from the United States. Canadian ticker, very, very much a U.S. company. For the vast majority of the Canadian tickers I hold, this will be the case. Now, we look to insurance pay. 90% of the business is from insurance and 10% is from customers. So you're relying heavily on insurance companies who are effectively forced to pay out repairs upon insurance claims. So it creates a very steady source of revenue, and it also creates a situation where a lot of the time Boyd can actually renegotiate payouts from the insurers. I mean, it's got very strong relationships with these companies. So we're looking at 978 stores across 34 states and 5 Canadian provinces. It doesn't really have that much exposure out east. It's mostly west. And if we actually come down to the overall market expectations, we can see what this is showing you here is the annual U.S. collision repair revenue. This would be 2006 to 2023. So we're looking at relatively flat post-financial crisis and during the financial crisis, and then we see a pretty consistent uptick. Obviously, in 2020, it dropped. We were global lockdowns. People weren't driving as much. And then we see a big acceleration coming out of the pandemic. One of the main reasons for this is the price of automobiles. Automobiles skyrocketed during the COVID-19 pandemic. What did this ultimately do? Well, it caused more insurance companies to make repairable claims over write-offs. So not only are new vehicles much more complex that require, the age of DIY repairs on vehicles is, especially when we get into the electrical situations of it all, and sometimes even mechanical, they're over. These vehicles are way too complex. So a lot of people are opting to get them repaired. And with Boyd being in the position it is right now as a leading auto body and glass producer, especially on the insurance side of things, it's going to generate a lot of revenue through this. And when we look to the industry compound annual growth rate, we're looking at a 3-year CAGR of 13%. Obviously, that is primarily COVID fueled. The price of automobiles has settled, but I will get to that a bit where some added tailwinds are possibly being introduced. We're looking at a 5-year compound annual growth rate of 6.26 and a 10-year of 4.8. So this 10-year compound annual growth rate doesn't necessarily look all that attractive from a investment point of view, but the thing you need to understand is a lot of Boyd's growth is fueled through acquisition. So not only will it benefit from this, near 5% compound annual growth rate, it's also going to benefit from being in such a fragmented industry and being able to acquire shops at discounted prices, especially if we potentially get into a recession, which I'll deal with that in a bit. I'll discuss that in a bit. But ultimately, the growth of the industry is not only what Boyd is going to benefit from, it's going to benefit from the sheer fragmentation of the industry. There will be no shortage of collision and repair shops for Boyd to acquire moving forward. As mentioned, it's, the second largest collision and repair shop in North America. It's probably one of the only publicly traded ones, and it has just a little over 5% market share. There is a ton of room to grow here. So we get into the headwinds. What has hit this company so hard over the last while, and why hasn't the share price done all that much? Well, effectively, we've seen, first off, used vehicles and new vehicles kind of flatline in price. Used vehicles actually started declining in price. So what does this do? Pretty much it makes it so that insurance companies are starting to write off more vehicles rather than repair them. And ultimately, this hits Boyd. It's had a slowdown in repairable claims overall. Insurance companies are now writing off vehicles that maybe during COVID, when the prices were way higher, they would have opted to repair them. So ultimately, that hits the business. That will eventually normalize, in my opinion. I don't think it will continue to last for a very long time. We can see a rise in total loss rates. When we look to this total loss share of claims, we can see that, back in 2022, it was only 18.8% of claims. Now we're up to 22%. So I do believe this will normalize over the long term. But another main issue that the company is having is we had the warmest winter on record in 2024. This is the warmest winter in over 129 years, negatively impacted collision rates. Obviously, when the weather is nicer, there's going to be fewer motor collisions, and ultimately that hits repairs for Boyd. Now, with the impacts of climate change, things like that, will this continue? I would say yes, winters will continue to get warmer. Would I say we're going to see another record winter next year? Difficult to say, but I don't really think this is going to be the average we see over the last while. I think we might get, a little bit of a balance to more severe winter conditions, which we kind of seen at the start of 2025. And finally, the third headwind is that economic situation. Consumers are struggling. So as a result, the company had mentioned that consumers are canceling comprehensive insurance and simply going with liability. So effectively, if they get in an accident and it's their fault, their vehicle would not be covered for the repairs. I could just say that this overall, for a lot of people, depending on the value of your vehicle, would be a complete disaster. But it's an effort to pinch pennies as insurance costs rise. And this is something that Boyd is just going to have to deal with over the short term. And I do believe when interest rates start to decline in the United States, people will probably, not feel the pinch as much, and they'll probably put collision on their vehicles, certainly the ones that deserve it. But right now, it's definitely a headwind the company needs to consider. So another thing on the automobile front is a lot of people are lumping Boyd in terms of tariffs into the automobile sector, which will be impacted quite a bit by tariffs. There's no question. But Boyd actually stands to benefit from tariffs. So we can go to the conference call to figure this out. So they ask, I understand the tariff situation remains pretty fluid, but curious on your thoughts on what the current tariff exposure might be. And they say on the part side, we're in a price list environment. So the list price goes up. That actually serves to create same-store sales for us. The inflationary environment will create same-store sales. We work on discounts off list to drive our gross margin in our business from a parts perspective. The other side of the inflationary or tariff environment, which is one of the most important ones I want to talk about today, is it could push new car prices higher, which increases the demand for used cars and in turn pushes used car prices up as well, which, as you know, then pushes total losses down. You'll remember when I spoke about the fact that Boyd is seeing larger total loss claims, so less repairable claims, because used automobile prices are falling. Ultimately, if auto tariffs are put in place, this will likely raise the price of new vehicles, which will put high demand on repairing used vehicles and also the overall demand for used vehicles, period, which ultimately will cause insurers to make more repairable claims. And in this end of things, that should help Boyd out. So tariffs are not really expected to be much of an issue right now, and I've seen a ton of people mention that they should avoid Boyd because of the automobile tariffs. This just isn't really the case. The company should actually stand to be neutral at the very worst and benefit at the very best. Now, all of these headwinds have, in my opinion, led to extremely attractive valuations. Now, this might actually confuse some people because when we go to a chart, a valuation chart of Boyd, we can see the company is trading at 135 times earnings, and it's trading at 30 times expected earnings. So this company does not look very cheap from an earnings basis. We can actually see a PEG of 0.27, which does kind of indicate that it is cheap. However, the more important measure for Boyd is going to be price to free cash flow and price to operating cash flow or cash from operations. Why is this the case? Well, if we go to Boyd's financials and we go to the cash flow statement, what you're going to see is a large amount of depreciation and amortization. And what this is Boyd's acquisition strategy. It does acquire a lot of companies. It acquires a lot of equipment overall that it pays for upfront. They're depreciated or amortized over a certain amount of time, which effectively reduces its earnings. But it's not actually a true cash expense in that year. So we're looking at net income of $33.5 million, and we're looking at total depreciation and amortization of $308 million. So that leads us back to cash from operations of $428 million. So with $110 million in capex, you're looking at, low $300 million in terms of free cash flow generation. And this is why the company is actually only trading at 14x free cash flow, which is, significantly below its 10-year median average. However, what I want to get into is the valuation from a price to operating cash flow basis. So right here, I have the price to operating cash flow for Boyd right now, which sits at around 10.44. When we look to 5-year median averages, we're looking at 13.26. And we look to 10-year median averages, we're looking at 14.66. So the company is currently trading at a 23% discount to its 5-year averages and is trading at an even larger discount to its 10-year averages. That combined with, a 14x price to free cash flow ratio, especially for a company that has grown this much over the long term, I do feel is pretty attractive. Again, when we look to that business makeup, this is primarily a US operator. If we look to, total revenue of $3 billion, $2.82 billion of that is coming from the United States. So this is a much bigger population. The economy is in much better shape, even though it is struggling a bit, but ultimately it's a Canadian traded ticker that is a US pure play. Effectively, we're talking about, again, 92% of revenue coming from the United States. And if we go down and look at total locations as well, we can add all 3 of their locations and we can get an idea of overall growth among these locations as well. And effectively, the Canadian end of the business is not growing all that well. In fact, since 2019, they've effectively lost 2 stores in the Canadian end of the business. But what is growing very fast is that US segment of the business. We can see here they have a compound annual growth rate on stores since 2012 of 15%. This compares to Boyd in Canada, 1.38%. So Again, this company is growing very fast in the United States, which is ultimately what we want to see. For a company trading at these price levels, I do think there is relatively strong potential here. And again, as I mentioned, I'm going to continue buying this company. This company, when it is in a normal operating environment, has done very well. We're looking at 231% growth in revenue. We're looking at 278% growth in free cash flow per share and 115% growth in earnings per share. However, you can see here with the earnings, if we were to actually take out this large dip in 2024, we're looking at 600% growth in earnings per share over a 10-year time period, and free cash flow would be around 350%. This company is experiencing some headwinds right now that I do believe are temporary and will fade. And the final thing I'm going to go over is their new 5-year target. So the company expects by the end of 2029 to hit $5 billion in revenue, $700 million in adjusted EBITDA, and be the number 1 or number 2 player in all markets served. Right now it sits at number 2. So obviously in the next 5 years, their best case would be to expand to the number 1 operator. The thing I do want to mention is this $700 million in adjusted EBITDA, that would be a 15% compound annual growth rate. And on revenue, it would be near that too. So if the company can actually hit this guidance and the temporary headwinds were to fade, I do believe, especially with the discount that the company is trading at right now and how high the valuations of the overall markets are, despite, correction right now in most US markets, I do believe that a 15% compound annual growth rate on both these numbers would lead to market beating returns. I would be pretty shocked at current valuations if Boyd can grow at a 15% compound annual growth rate, that it would not top most major indexes, all major indexes here in North America. Obviously, guidance is guidance. Anything can happen. The company did fall short of its previous 5-year targets, but was well on track to hit them up until the headwinds in 2024. So everybody, that's it for the video. Head down below, like the video, subscribe to the channel, comment down below. Let me know if you know of Boyd. Let me know if you're buying it. And as always, everybody, that free report down in the description, 3 of my favorite stocks for 2025. And we'll see you next time for more great Canadian content.